Hello and welcome to With Anderson. This is a channel where we talk about economic, political, and some financial things in simple terms. Today is the third episode of Recessions, and by the time you finish watching my video, you should have a good understanding in plain English what a recession is and how to prepare for it and what would be the signs. At the end, I'm going to give you a summary on what I think might be coming down the line. But my suggestion to you right now is to please to register or click a subscribe button at the site so you don't miss anything. Let me briefly tell you how I came across this. I used to take buses into New York City on a daily basis, and I would pick up two newspapers, and they were financial newspapers, the Wall Street Journal, and the other one was I believe it was the Investors Daily. And I used to read them, and I constantly get confused. I couldn't understand what they were talking about. So I decided I was going to try to learn the terminology that they use. Okay. Let's start with what is recession. Recession is two consecutive quarters of negative GDP or gross domestic product growth. Growth actually would be lessening. Okay, what is the gross domestic product or GDP? You've heard that term before. It is the value of a country's sale of finished goods, imports less exports. Exports less imports. Only finished goods. So like a house that was built a couple of years ago and resold is not a finished good. What is the sign of recession? Well, there are low wages, the credit contracts, hard to get loans, unemployment, housing sales drop, and there's a reduction usually of working hours. You will also see perhaps downsizing. You'll see the market, the S&P change and drop, and bond prices will rise. Okay, what are the tools economists use to measure recession? Well, one is called the federal funds rate. The federal funds rate is really the rate the banks give their best customers, and their best customers are other banks. So why do banks need to lend money to other banks? That's because at the end of the night, when they open business the next day, they have to have reserves. What is a reserve? A reserve is amount of money that you have to have when the bank opens to make sure you can meet the people who are going to make withdrawals. Okay, now we're going to talk a little bit about the Fed's fund rate. The Fed's fund rate, as I said, is the amount of money that you lend your best customer. And that's usually the biggest indicator, one of the biggest indicators on how rates will rise. As of 5/04/22, the Fed fund rate was 1%. A month later, we're waiting for the yield. It hasn't come out yet, but the Fed has already said they plan on raising the Fed's fund rate for the next 2 or 3 meetings they're going to have. Now, what is the Fed? The Federal Reserve System, is a central bank, and their responsibilities are multiple. One is to manage the money supply. The other is to be the lender of last resort, to fight inflation, make sure that the economy is at full employment, and they have some other various duties where they monitor the banks and financial institutions. The second thing we're going to use that is used by economists is measuring the stock market. It's usually a forecast of what's going on in the economy. We're going to pick the S&P 500, which is the Standard & Poor's Index. The reason why I selected that was because that is the broadest index of the larger companies. And this is what I have for you as far as the changes. On April 13th, 2022, the S&P 500 closed at 4,407. 06, 2022, or May 6, 2022, it was 4125. So it had, the stock market had come down. But as of the last reading, as of this date, which is 5/27, the stock market is 4158, the S&P. So it's pretty stable, it's dropping, but it's stable. Another tool they use is called the ISM PMI. Don't get afraid. It's pretty simple to understand. The ISM is called the Institute of Supply Managers. The PMI is the tool they use. And it's fairly simple. What happens is they poll 400 purchasing managers to see what the future looks like for them. That's a great indicator on what people are going to be buying. They ask the purchasing managers what purchase orders they have, what are their planned purchases, what does the inventory look like, what does the sales look like, what does employment look like, and from that, the ISM can discern, looking into the future, what's the possibility of recession. Now, you've heard probably there's something called the yield curve, a yield curve inversion. Let's talk about the yield curve first. Let's talk about a yield. A yield is something typically you're going to get by making a fixed investment, like a bond, okay? And what the yield curve itself is plotting that investment over time. Now, the inversion is what's interesting. Think of it this way. There are 3 types of bonds issued by the Treasury. By 3 types of not only called bonds, but there are bonds, notes, and bills issued by the Treasury. And they issue for various times. A yield curve inversion would mean that a bond that was issued, let's say for 2 months, would yield more money than a bond that's issued for 10 years. Why is that strange? Because typically when people put their money into long-term investments, they get a higher rate. In this case, people are afraid to put their money into American Treasuries for 10 years. So what happens is the bond prices for, or not the bond, let's say the bills and notes prices rise and exceed what a 10-year investment is. So that's kind of scary. Now you got to keep in mind, the Treasury notes are the safest investments in the world. You can't get a better investment than that. Okay. Now, investments in bonds typically are long-term investments. They probably investments for a long time. So, again, just so you understand, a yield curve inversion would be when people have less confidence in keeping their money in the American economy for a long period of time. They're scared. So they want to get the best house on the block, but they're not willing to stay there that long. The housing market is a 5th element that we use. And the housing market, the American dream, recently has been shrinking. Since March and since May today, 18th, there's been a contraction in the new housing being built. The 6th element is unemployment. It appears that the unemployment rate right now is about the same as it was, 3.6 in February, March, and April. There's been no changes there. Okay. Now, what causes recessions? Well, one thing would be a lot of money chasing few goods. That's causing inflation, but that can cause a recession also. There are also things called black swans. And what they are unavoidable events that occur that come along and impact the economy, such as the Ukraine-Russian war, the inflation, climate change, shortages that are happening in the supply chain, crowding out. What crowding out is important because crowding out means that people are willing to take their money out of the stock market because they're scared of it and put it into government funds, which means that there's less money in the market and less money at work. Some other things that cause a recession would be low or high interest rates or excessive government spending. Now, I mentioned the Fed, and I think it's important that you understand what a central bank is. But before I do that, let me remind you again to subscribe, because this is going to be a monthly thing, and I don't want you to miss anything. Okay, so the Federal Reserve, or in this case we call central bank, has counterparts all over the world. In the United Kingdom, it's called the Bank of England. In Japan, it's called the Bank of Japan. And in Europe, in general, it's called the European Central Bank. Their roles are simple, like the Fed: a stable money supply, unemployment, the lender of last resort, keeping banks honest, and monitoring inflation. They also provide guidance. They do manipulate the monetary or interest rates. They provide liquidity when it's needed. And they also employ something called a balance sheet, which I'm not going to get into right now. We'll say that. At this point, I'm going to give you a summary of what has happened since the last time we met, or the last video you saw, and what's happened today. Okay, Jamie Dimon, who is the CEO of Morgan Bank, says that he believes there's a good possibility of recession coming. President Joe Biden thinks that he can control it. That's a New York Post issue. On 4/21, the Dow Jones Industrial Market dropped 1,000 points. 4/26, China cut its GDP, and Nomura Securities said that. Now, why that's important is because, again, we live in a worldwide economy. What happens in China could affect us. And the U.S. market for the first quarter did show recession. The GDP did shrink. And also, it's important, we talked about the yield curve. A yield curve inversion occurred. These things alone are extremely scary. Janet Yellen, the Secretary of Treasury, says she believes, and this was on 5/9/22, that there will be an orderly end to this madness. On 5/11, inflation came in. It was recorded at 8.3%. Also, it is forecasted that Social Security payments made to Social Security recipients in 2023, based upon inflation, is going to be in the 8% range. Also, Walmart, Target reported significant losses. Okay, and that's a very serious thing, because it shows that there isn't that much money in the money supply out there. Gas prices are up. The Dow Jones Industrial Average until today, which is the 29th of April 2022, until this week has been down for 8 straight weeks. So, the outlook. Guys, we got something to worry about. Reason why is, I was around in the 70s, and this is kind of strange. In the 70s, there was room for the Federal Reserve to impact the market and drive out recession. There is no room in the Federal Reserve right now for that. I really feel that you really need to be conscious of what you're doing. Save your money, get down, reduce your expenses, and make sure that you register and make sure that you subscribe so you get this information on a monthly basis. It's your financial life. You need to plan for it. Thank you very much and have a good day.